Today we're diving straight into something we all use literally every single day, but kind of rarely think about: the hidden economics of modern banking. We're going to completely peel back the curtain on how these massive institutions actually make their money.
So here's a wild contradiction for you. You walk past these enormous, gorgeous bank buildings, right? They look like they're just overflowing with cash. But history tells us time and time again that these absolute titans can and do collapse practically overnight. I mean, how on earth can an institution holding billions in wealth suddenly run out of cash? Well, we're going to answer exactly that by looking at the reality operating just behind those marble walls.
But look, to understand the massive global picture, we actually have to start super small. It all begins with this: just a simple, everyday $10,000 personal deposit. Maybe you wire it from your phone or hand a check to a teller. It seems totally mundane, but this specific chunk of change is the literal building block of the entire global financial system.
Now, when you open up your banking app and see that 10 grand sitting there, you naturally think, awesome, that's my money, it's your asset. But, and this is crucial, flip that perspective for a second. To the bank, your deposit is actually a liability. Yep, a liability. Why? Because they literally owe that cash back to you. They're essentially borrowing your money, and they've got to put it to work immediately to pay you back and, keep their own lights on.
Because your money definitely doesn't just sit in some giant vault gathering dust. No way. The bank pulls your 10 grand with money from a bunch of other people to issue something big, like a $400,000 mortgage. So the cash flows out to a borrower buying a house, and in exchange, the bank gets a loan asset. Basically, a legally binding promise that generates a steady, reliable stream of monthly interest payments flowing right back to them.
Okay, let's scale this up to make the math clear. Imagine a hypothetical $100 billion bank. Their primary profit engine is what's called the interest spread. So on one hand, let's say the bank earns a 6% yield from all those loan assets, bringing in $6 billion. Awesome, right? But wait, they have $3 billion in funding costs, which includes the interest they pay out to depositors just like you. The bank's actual profit lives right in that sweet spot, the space between those two numbers.
If you really want to sound like a Wall Street insider, you need to know this exact term: net interest margin, or NIM. It is simply the difference between the interest income they generate and the interest they pay out, relative to their earning assets. It's the ultimate financial pulse check for a bank. If this margin gets squeezed too tight, well, the bank is in serious trouble.
But here's a pretty harsh reality in the world of finance. Billions in revenue absolutely do not equal billions in profit. That $3 billion of net interest income, it gets eaten up super fast by operating expenses. You've got to carve out a slice for credit losses, then massive costs for employee salaries, tech infrastructure, cybersecurity, compliance, taxes, the whole shebang. By the end of it, that remaining slice of actual profit is way smaller than most people realize.
And to fund all those massive loans in the first place, a bank just can't rely on everyday retail deposits alone. It's not enough. They have to pull from a bunch of diverse streams. So, beyond your checking account, they rely heavily on wholesale funding, which basically means borrowing from other financial institutions and various other liabilities just to support that huge asset portfolio. It is a wildly complex, interconnected web of borrowing just so they can lend. So let's talk about the absolutely massive stakes involved in managing credit risk. Accurately estimating if a borrower might default is, well, it's survival. If our $100 billion bank suffers just a tiny, seemingly insignificant 2% credit loss, boom, that instantly transforms into a devastating $2 billion problem. Literally a fraction of a percent in miscalculations can wipe out an entire year's worth of hard-earned profit.
Which perfectly segues into a concept that essentially defines modern banking: leverage. Leverage is basically using a relatively small layer of shareholder capital to support a massively larger balance sheet, which is mostly funded by your deposits and those wholesale liabilities we just talked about. And leverage is totally a double-edged sword. It can brilliantly amplify shareholder returns when the economy is humming along, but it will fatally multiply asset losses when things go south. It is one heck of a structural balancing act.
And this creates a really dangerous tension. On one side, you have liquidity, meaning immediately available cash. On the other side, you have illiquid long-term assets. Think about it. A bank can hold billions of dollars in highly valuable 30-year mortgages. But if they cannot meet the immediate cash withdrawal demands of their depositors on any given Tuesday, the bank fails. They might be rich on paper, but they are flat broke in reality.
Which brings us to arguably the most terrifying phrase in all of finance: the bank run. This is what happens when thousands of customers suddenly lose confidence and try to pull their money out all at the exact same time. And with modern banking apps, this happens with terrifying speed. Everyone rushes for the digital exits at once, and those available liquidity indicators just plummet to zero instantly.
We actually saw this chronological domino effect play out on a global scale during the 2008 financial crisis. Falling housing prices in 2007 rapidly spread through securitization and heavy leverage. Because global funding is just so heavily interconnected, that stress utterly crippled major institutions. You had Bear Stearns sold off under intense duress in early 2008. By September, Lehman Brothers famously filed for bankruptcy. And right after that, AIG needed extraordinary government support just to stave off total collapse.
So what exactly happens after a systemic heart attack like that? A massive regulatory response. Government stepped in and implemented strict control systems to manage these risks. Today, banks face incredibly strict capital and liquidity requirements, rigorous stress testing, and continuous government supervision. Meanwhile, everyday retail customers rely heavily on deposit insurance, just to maintain that baseline level of confidence.
Now, to survive and thrive today, banks don't just rely on interest spreads anymore. They generate huge amounts of revenue by expanding their relationship with you way beyond a basic checking account. They want to manage your wealth, handle foreign exchange, advise on corporate finance, originate your next mortgage, and run all your payment services. The ultimate goal here is locking in decades of fee-generating services from every single client.
Just take a simple restaurant payment as an example. You swipe your card to pay a $100 dinner tab. Well, in the literal milliseconds after that swipe, a massive digital ecosystem springs into action. The card issuer, the payment network, the merchant processor, they all jump in to extract different little slices of hidden fees from that one single transaction. These invisible fees are a massive, massive economic driver for the industry.
But of course, modernizing all this isn't free. While smartphone apps and digital transfers definitely reduce the costs of running brick-and-mortar branches, they create huge new, hidden expenses. To run these slick, high-tech platforms, banks have to fund 24/7 cybersecurity operations centers and run continuous AI-driven fraud prevention systems that analyze endless streams of data. The security battlefield has literally shifted from thick steel physical vaults to complex digital networks. All right, so let's bring it all together and look at the true economics of our hypothetical $100 billion bank. They pull in $6 billion in interest income. Great. But then you subtract $3 billion for funding costs, you subtract another $800 million for credit losses, and then another $1.5 billion for operating expenses. The final estimated profit? Just $700 million. That's a tiny fraction of the total revenue, which really proves just how razor-thin the margins in banking actually are.
So the ultimate takeaway from all this is that banking is a perpetual high-wire balancing act. Every single structural advantage carries a directly corresponding, potentially fatal risk. Lending and leverage, they are incredibly powerful tools for growth, for sure, but they are constantly, always being offset by the looming threats of credit losses and sudden liquidity runs.
Which brings us full circle right back to your original $10,000 deposit. See, that money never just sits idle. It's constantly moving, flowing through a wildly complex balance sheet, acting as the very fuel for mortgages, businesses, and really the wider global financial system we've just spent time exploring.
And when you strip away the leverage, the sleek mobile apps, and the heavy steel vaults, the entire system rests on an entirely invisible foundation. To quote an industry truth, banking ultimately depends on confidence that financial promises will be honored. It is an industry literally built entirely on trust. If that trust evaporates, well, the math simply ceases to work.
We've unpacked the mechanics, the incredibly tight margins, the systemic risks, and the unseen realities of where your money actually goes. So, now that you really understand the invisible forces at work every single time you check your balance, I'm going to leave you with this final thought. Will you ever look at your banking app the exact same way again? Thanks for hanging out with me.